I'm your moderator for the panel discussion. I've already mentioned this to you guys, but I'm a reporter with Economic Times. I write on consumer and retail brands, and I'm really excited to have you all here. I'm just gonna, walk the table across, and could you tell us a little bit about what you guys do, and we can jump into the questions right after that. So we'll start with Maxson.
Right, hi. Good day, everyone. My name is Maxson Lewis. I'm the founder and CEO of Magenta Mobility, India's largest electric cargo fleet operator. We started in 2017, seed funded by HPCL, Hindustan Petroleum Corporation Limited, at this point in time, and then funded by BP and Morgan Stanley. At this point in time, we own and operate a fleet of more than 2,400 electric vehicles. So the next time if you have received a shipment at your home, possibly that's been transported on an electric vehicle. But I take pride in saying that besides that, we transport lubricant oil on our vehicles, mattresses, bikes, and a lot of other things. So with a mandate to decarbonize logistics.
Okay, that's pretty interesting. Over to you, sir.
Hi guys, Amitabh. I run Altigreen. Altigreen is a EV company. We have a very long history. We've been in the market for about 12 years, but largely on the tech side. We were the guys who created technology on EVs much before Atmanirbharta became a household name. Even today, our EVs have about 93% domestic value add, which is much higher than anything that you can expect. Even as a young company, we have about 32 global patents that are being granted on us. And we are very thankful to Magenta Mobility. They have a very large fleet of our vehicles. We have about 5,000 odd vehicles on India's road, done about 65 million kilometers on them, seen many summers, many winters of India. So overall good, yeah. Otherwise, background is largely of computer science. And so I preach a lot about the need for software in electric vehicles. Without software, you don't have EVs. So that is going to be the big thing. Yeah.
Interesting.
Thanks, yeah.
Okay. Hemanth, over to you.
Yeah. Hi, I'm Hemanth. I head marketing at Ninjacart. Ninjacart is an agri-tech firm. It's currently the largest agri-tech firm. We've been around for around 9 years now. Primarily, we started off as a B2C organization, trying to do what the Zeptos and Blinkits are doing today. But then at that point of time, we pivoted to a B2B model, where we primarily service the value chain, entire food value chain, which is right from the farmers, the farm to fork model, which farmers, which is your traders as well as your retailers. We look at supply chain efficiency. We've built marketplaces for interaction between these stakeholders, and more recently we're into the fintech space as well, where we're providing finance solutions for these guys.
Vanda.
Hi everyone, my name is Vanda. I'm the CMO of Bowskin Science. Bowskin Science is one of the leading D2C brands. We shake up brand playbooks by creating our own and defer whatever the legacy players are doing. Built really strong brands loved by consumers. We sell on our own website, we sell on marketplaces, and also now, because of a lot of love of these brands generated online, we are selling also on in GT and in physical stores.
Yes.
Happy to say that I started my career and worked with FMCG, worked for a long time with Britannia. So the playbook was really set in how brands are built.
Yeah.
But happy to, in the last 6 years, worked with startup brands right now and doing everything completely different, but still building power brands. So happy to be on this August panel.
Thank you so much for that, Vanda. Ankit, I've used your bikes. Very interesting.
So, hi everybody. My name is Ankit. I work at Yulu and handle marketing for them. Yulu, since a lot of you are Bangaloreans, I think Yulu's been something that you've seen over the last 4-5 years.
Yeah.
But we are India's largest shared electric vehicle, two-wheeler shared electric vehicle company. Just for context, our bikes get driven for over 500 million kilometers every month. We power anywhere between 6 to 10 crore green deliveries every month.
Wow.
So the chances are that if you've ordered anything on Zepto or Zomato, there's a high chance that it was delivered on a Yulu. I think the thing that people don't know about, but which we think is a great area that we would like people to know, is that we take a little bit of guilt out of your ordering at home. So, the deliveries are green, it's clean, there's less carbon footprint. Vehicles are small in size, so there's less traffic footprint. And I think one of the other things that we are able to do is there's a huge gig delivery workforce that's out there.
Yeah.
And a lot of them are underserved. So they do not have access to capital or to documents. And our solution is something that allows them to get access to mobility, which in fact is one of the biggest things that gives access to a better future. So we are happy that we are creating a social impact as well through this service. And the hope is that we will be able to evolve into a shared mobility solution provider. So while two-wheelers is one thing that we are doing right now, but we see a tremendous scope for shared electric mobility in India as a country to create impact. So that's what we do. I've been with Yulu for 2 years. Before that, I was working at Mahindra, and Mahindra used to handle some of their iconic automotive brands, Scorpio, Thar, XUV. These are brands that I've worked on. And this is a very different world, but I'm very happy that I get to delve into a lot of different aspects of building a company. So that's where we are. And I would love to talk more about what Yulu is doing.
And we will.
I'm happy to be here with all of you.
Thank you so much, Ankit. Vinod, sir.
Hello. Good afternoon. And myself, Vinod. I am heading the finance function of Medfin.
Yes.
It's a healthcare company. A brief introduction about me is, after my education, I worked with around 10 different industries. I was the first 5 employees of Yahoo in India, set up 2 companies of Yahoo in India, and then I worked with Elder Pharmaceuticals, Kingfisher Airlines. I had my own startup similar to Zomato for 5 years. Then after I moved to a musical startup, then Furlan Co, Sesh Money.
Wow.
Yeah, so and Dish TV US.
Yeah.
So definitely quite various industry experience.
Yeah.
That's personally about me. About Medfin, right now what we are focusing is on daycare surgeries.
Mm-hmm.
We are a Uber in the field of in the daycare surgery. We don't own any hospital, but we do around 850 to 1000 surgeries a month.
Okay.
So how we do is, we tie up with hospitals, where in which we offer an additional incremental income. Whenever the OT is free, we use it. So it is an incremental income for them. For the surgeons, we don't pay salaries. We pay commission based on the work done actually.
Okay.
So this is how we reduce the overheads. And for the customer, for example, it's a hernia surgery, one of the top hospital in Bangalore might charge around 3 to 3,50,000.
Yeah.
But through us, it could be done in anything between 80 to 120.
Okay.
Yes, again, it depends on the comorbidities, etc.
Yeah.
Yeah. So there could be anything between 40 to 60% cost. We can, reduce it for a end customer.
Wow. Okay.
So that's what we do in Medfin actually.
Okay. Thank you so much, sir. Last but not the least, Abhishek.
Hi everyone, very happy to be here. This is a very diverse, dynamic group, so happy to be here, share my experiences. So I take care of business and operations for Captain Fresh. Captain Fresh is one of the world's largest seafood B2B platforms. We are obviously the largest from India, but one of the world's largest now. We've had at last 2-3 good last few years, so that's really helped. Fundamentally, we are a B2B platform that services all retailers and all Horeca or all restaurants that you can think of. Very similar to Ninjacart, what they do in agricultural products, we do in seafood. I think the reason why we exist is because we have figured out a way of supply chain operation which is tech enabled, not asset heavy, and seafood is a very asset heavy business because you need factories, you need trucks, you need cold chain, you need all of that, but we are not asset heavy, so it's very tech enabled, but we are actually a supply chain operator, so we don't we are not a tech play per se, we are tech enabled. So tech is one part of it, but we shift. I think last year we did a little over 80 million pounds of seafood from 8 countries in the world to 7 countries in the world. So we started off, of course, as being an India player. We used to buy in India, sell in India. We became the largest in India within 1 year. Oh, the other thing is we are 4 years old as a startup. Before Captain Fresh, I spent 12 years in fashion. Worked with the Tata Group, worked with Myntra, got the opportunity to see both of, I mean, not the Tata Group obviously because they were already established by the time I joined. But with Myntra, really got the experience of seeing that scale from nobody knows Myntra to everybody knows Myntra. So that journey was great. And yeah, with Captain Fresh it's been great. So from fashion to fish, it's been a little bit of a good ride, yeah.
Okay. That was really helpful. So now that we know each other a little better and we understand our skill sets a little better, I'm going to jump right in, right? Now, the topic in hand that we have today is what next after a product market fit, the growth versus profitability conundrum. And I'm pretty sure every founder is aware of it and has dealt with it, and every investor has made sure the founder has dealt with it. So having said that, I'll start with a very, very basic one, right? Like most companies, when we are talking about growth versus profitability, the one thing that as a reporter I get to hear a lot is that, oh, we're trying to strike a balance. What does balance look like? Let's just ask that question first. How do you define, oh, we are in the right mix of growth versus profitability? Anyone can take the question, please. Please, sir. Yeah.
So, every startup needs to think about this, and I think it's important to think about it upfront. This is my third startup, but the most difficult one, because when you're talking about an automobile, a three-wheeler might be considered simple compared to a four-wheeler, but it still has like hundreds and hundreds of parts and thousands of suppliers who are supplying all these. It's extremely difficult because you need to do a lot of R&D, especially in a sunrise industry. So you're doing a lot of R&D, which means you're spending a lot of money in coming up with something which then you need to establish and then create material margins on it, and then create EBITDA margins, and then create profitability. Multiple steps in the process of doing it. The important thing is to keep that in mind. I think here is where we sometimes tend to fall into that Amazon, that pit, right? It's like, it's okay, 3 decades I can be loss making and it's still okay. I think perhaps India, perhaps the automobile industry, perhaps specific industries where there is no wave, we will have to be extremely careful upfront. In terms of establishing this balance. Now the balance is, like you asked, is different based on the vertical or the industry that you're in. For us, a balance might be just material margin is good enough as a starting point.
Okay.
Because by the time you get to profitability in an EV, in a sunrise domain, which is completely new, where you're building up this thing, you're fighting against a 100-year-old technology that has been around, you're taking people from certainty to uncertainty, lots of factors.
Yeah, of course.
Getting to profitability is far away. Right? But to be able to build material margin, which means that every time you sell a vehicle, you're making money. Trust me, very few companies in the world today for EV only businesses will be able to say that.
Okay.
Trust me. It is impossible to do that just because it's very, very expensive to do. So different people will have different things. The important thing is upfront you should know, you should see a path to profitability. I think that is very important. That visibility towards that profitability is extremely important. And I think more and more VCs will keep asking this question now. There was a time when it didn't matter. Checks were being written, one-off, VCs writing checks and all that. It's completely changing. This industry is changing very, very rapidly.
Okay. I'd like to hear what others have to say as well, because we also have consumer product companies and we have tech-based companies as well, right? And the little that I do know of the balance sheet, it looks very different. Profitability and growth for both the industries look very different. So please, Wayne. Yes, sir. Yes.
So see, let us look at the balance sheet first, and what is the fund available. And what next is whether do you have access to capital. When you get the money exhausted, then you have an access to capital. That should be the starting point of this balance. See, when you know about that, then only you can play the game, whatever game you are playing, whichever industry. See, that is the key. And also, like if you look at traditional small businesses, so they don't have the bandwidth to look for a long-term spending. It will be short actually. So it depends on the type of business, whether it is proprietary or that kind of a structure. And second aspect is whether you are funded company. Like if you are a venture funded company, yes, if a sole proprietor may operate for 10-20 years to come up to a larger level, but in the game of a venture funded startups, the game is shrink to around 8 to 10 years, or that is where the VCs want an exit. So the play is very intense. That is where we need to speed up the game actually. So there will be lot of firefight over there, and learning, all those things are there. So it depends on each type of industry, and also like what is the environment, market environment, as well as the company strength and weaknesses actually.
Of course.
See, market, when I say market, it's not only about the customer, what the customer want, also like currently which is relevant is the funding market.
Of course.
Whether the US, Europe, the recession is, it's predicted, and whether the funding is going to dry down. Now, which are other market you can tap on. All these factors will definitely matter. So based on what is the fund available, that is where, and then within the fund available, we have to create, games. How many cities we are playing, or which city, and also whether you are selling a product or a SaaS product, or or a service. Based on that, we have to create the game actually. That is where the balance can be.
So actually, I have a point of view being a person who spent close to around 20-25 years before Magenta, and then 5 years building Magenta. So there is a kind of a different view of how I look at it. So the business of business is to create profits. I think the moment we start to think, so I always call it P before G. So profitability before growth. Of course, you need to have a certain runway before you can clock in, because it's basic unit economics over spread across. But I think there's a geographic layer to these conversations around growth and profitability. The punts that are taken in the Western world are larger in terms of check size and also in terms of the tenure, because the governance systems, etc., are actually well founded. It has close to around 50 years of VC funding that's established. I believe that the India market and the Asian market is a playbook of wafer thin margins, and each one of us knows this, right? And to get to that, I think everyone, including the founders and now the VCs also, the conversations have changed. But net, if you do not have a view of where you're going to eke out that wafer thin margin, then you are desperately in the business of burning money. So I think this is us trying to copy the Western world's view of VC funding or profitability versus growth is slightly different. That's one view of what I have. The second thing is, I think the maturity of the money market is already here, and I think the India market has matured much faster than the Western world. So the conversations have totally changed. I mean, we talk to investors, etc. The conversations have changed.
So sorry.
No worries. Another thing is the fact that the money market has actually matured, especially in India, matured a lot faster, because there's a lot of learnings from the Western world. The conversations have changed. The money bags are no longer asking about, earlier it was about how much you need. That was the only questions was asked. It was just a due diligence on the founder, the business model.
And how long ago was that? When was
I would say even a year, I would say 12 to 18 months ago, I think the conversation was very different. In the last 18 months, it's not winter, it's ice cold.
Wow.
So the conversations are really about, hey, listen, we understand you as a founder, we understand your business model, but show us the path to profitability. And profitability is now those three constructs that you talked about. It's gross margin, EBITDA, PAT. It's exactly those sequences, and those conversations are happening on the table upfront. So I think that's my view. So while the industry there's different way of how growth versus profitability, but losing sight of profitability purely because of growth, I believe that's something which I feel is a negative cycle which will catch up one of these days.
But if I may add, I really liked what Amitabh sir mentioned, like, how earlier we would get into that Amazon, this thing like the 30 years of losses. But yours, Vanda, is a e-commerce this thing, and e-commerce, and yours as well, right? Are you guys...
I mean B2B, B2C.
Okay, fair enough. But let's talk about B2C first. Like, they're quite synonymous for not making profits for a really long time. How has this question played out for you guys?
Yes, I mean to say, concur with whatever you all have said earlier, and profitability is the most striking question which everyone asks you, and it's up till packed. So they ask you also in terms of how do you, what's the path to profitability?
When you say they, you mean the investors.
Correct. But I think what how we maneuver it is, see, if it is an organization I worked in prior, right, which had volumes, which had the long lead time of innovation, and you had to actually invest in considerable capex, for example, setting up a plant to make a certain kind of a product, etc. The benefit for our kind of industry is the volumes are lesser. So you are not really saddled with high MOQs or, huge costs at the time of launch. So what we do is we work on trends. So there is something in the beauty and cosmetic space. There are lots of trends which actually come about, and I think insurgent brands know how to sniff these trends ahead of time. And I think tailwinds of the pandemic also really worked in our favor, where the audience was up and right there waiting to adopt things for hair, for skin, etc. So that really worked in our benefit, and therefore how we go about doing this is we don't incur these huge costs at onset only, and we actually see in terms of, for example, a batch size of a shampoo or conditioner made, how do you realize the revenue? So you have a PO which comes from a marketplace, and you know that there is an intent, and so then you start making money on that. And also the big heads of cost which come, right? What we try to do is variabilize it. So manufacturing also, it's not your own. So you have, for example, a player who has the expertise. So what you bring to the table is your formulation. That is your trade secret, right? So you make it. Then it comes in terms of marketing, because marketing is also a huge cost. What we do is we try to be able to splice and dice a certain geography to be able to do a test market, for example. Then we also do digital media, which you don't need to actually spend along the likes of mainline media. So it's not TV. So you can actually isolate a geography. So what happens is then you do literally like a test market. You launch a product, you see how it's shaping up. And more often than not, because it's on point, because you know innovation and you've put in the effort in the formulation, it does really well. Else you can amend the product as you go, because your batch sizes aren't huge. You're not saddled with a lot of inventory in terms of product aesthetics or nanoleptics. You can keep on changing it. So what happens is that itself is product market fit of how you keep on continuously improving it over time. So you can actually iterate the entire launch process to be able to then always know that you have to make money. So P&Ls for every brand, every channel, every geography are also literally institutionalized. So you own that. So the team also knows that they have to deliver a certain margin. And whenever we are innovating a product, right, we know that this is going to sell on XYZ channels. We actually see the entire cost sheets, knowing that we have to work at a certain ASP. So you have to realize money at the end of the day. I think what we do in terms of the development process keeps us in good stead to then be able to realize money better.
I also want to understand, one cannot come at and neither of them can come at the cost of scaling a business, right? And the use of technology for scaling is something that is inevitable, or even like you can't really skip it either, right? So Hemanth, if you could tell us a little bit about how Ninjacart has been using technology for scaling and keeping in mind your profitability or growth. Let's start with what is your first goal right now? What is it, profitability or growth?
Like, probably just to continue with the whole conversation and link it up to what you asked me, right? So the agri-tech space is very interesting because it's also a very low margin space.
Yes.
And when it's a low margin space, I guess the debate becomes a lot more meaningful, or it's something that you've got to really decide up front.
Yeah.
Sure, we all hit PMF, and once you do PMF, you're looking from a growth or profitability angle, but at least our viewpoint has always been that if you tackle the bigger problem first. For us, the bigger problem is profitability, right? Where you try and achieve unit economics there, figure out profitability at that level. And the more important thing for us, because we are also an operations heavy organization, is that when you're deciding to scale, the cost structures have to maintain itself. Because as soon as you scale, if the cost structures just break down, then the growth story is not really relevant.
It's very counterproductive.
So from that standpoint, I think primarily we look at profit first.
Yeah.
But once you've achieved, or you're fairly confident that the structures will be consistent throughout, then we look at scale, right? But from an approach standpoint, it's pretty much the same. You look at you do a PMF, you look at a test market, you do all the iterations in that test market, figure out what are the variables that's really going to change, and then to scale.
Yeah.
Now the big thing, at least from our standpoint, when it comes to our industry, is that tech is hardly prevalent here, and tech can really make an impact in the space and across the value chain.
Yeah.
Like at a very basic level, operational efficiency is sees obviously multiples in terms of reduction of cost, right? When you employ tech. Like one example that we can give you was the crates that are usually used to transfer stock from one point to another across the cities is invariably lost, and that's a huge expense. We had embedded RFID there so that we could track these crates with RFID and then bring them back to source, thereby reducing cost to a certain extent as well. So obviously there's various levels of tech. From the marketing space, we look at tech more from the viewpoint of how you can streamline the journey of a consumer, right?
Yeah.
You leverage tech to ensure, because see, also our environment is one where our consumers are not really tech friendly. So if you go and suddenly say, hey, here's an app, you can do everything on the app, they're going to just look at you and wonder what's wrong with you. So there is this balance you've got to strike where you introduce tech, but you also educate them, drive that awareness, and bring that adoption of tech before you can eventually scale it. Right?
Yeah.
And when it comes to marketing, I think the place where we really leverage tech is eventually in the ad space, because there's a variety of things that you could do to move from, let's say, offline channels, or you can move outside your ecosystem channels to your entire product ecosystem channels, right? And that reduces cost quite a bit as well. So there is leverage. We do leverage tech across multiple spaces, but it's had immense impact here.
Understood. My next question, Abhishek, is for you. You mentioned that you guys have been around only for 4 years, right? By then, the meats e-commerce space was kind of, the bigwigs were already there, if I may say so, right? I understand you guys are focusing on the B2B side of the business, but how has customer acquisition costs been for you guys, especially when looking at growth or profitability? And also, if you could answer right now, what are you guys focusing on?
So I think I'll start with just, in my mind, I don't think you've achieved PMF if you haven't fixed both.
Fair enough.
I mean, just not from a PAT level for sure, but at least at a contribution margin level or a gross margin level. The point that Amitabh was making, right? You can't claim to have achieved PMF if you aren't making X positive, any X, decimal point X, positive for every product that you sell. All your fixed costs, corporate costs, all of those costs can be below. That's fine, right? I think that's one. Two, when we, at least for our industry, and we are a commodity, so seafood, while it is nice and fancy and all that, it is a commodity at the end of it, and everybody looks at it as a commodity. I think in the commodity market, not only are the margins very thin, the competition is very unorganized. So what that means is that you're competing with people who don't have your cost structures, right? Which means that you definitely need to, not only your table stakes are to be efficient. Tech definitely helps, and we've literally built a lot of our economies of scale, a lot of our leverage, everything through tech, and that's really helped, and it plays out over time. But coming back to your question on how do we look at growth or profitability, we started looking at growth after we achieved profitability.
Understood.
Right? I think that was step number one. We were lucky enough to be in an industry, and thereby this comes with a pinch of salt. I think if you're in an industry which is highly competitive between organized players, then you have to take a call on whether you want to win or you want to die. Right? Because I mean, if I look at any space today, right? If I look at e-commerce, when I was in e-commerce, it was Flipkart versus Amazon, Myntra versus Jabong. It was, or now it is all the quick commerce guys fighting with each other. In that kind of a scenario, you have to possibly let go of profitability for growth, because you can't be a really profitable company that doesn't exist. Right? It's difficult. And so, you know, that those are the calls. But in our space, luckily or unluckily, at least in India and even globally, our method of operation or our way of working, we don't have competition. And so we were lucky enough to to prioritize profitability and wait for growth while we did that. That being said, I mean, we did grow 3x, 4x every year, at least for the last 4 years. But achieving profitability was number one. That is always this one. I also think that most startups make the mistake of trying to short circuit success. One is redefining PMF, right? Saying that I sold to 1,000 people so I achieved PMF. No. You have to sell to 1,000 people and you have to make a little bit of money to say that those guys value you know, what you're delivering to them. And two, I think the biggest problem with startups is that they spend too much money trying to learn. And they don't learn fast enough, especially when the money is scarce. Right? And to your point, Maxson, I think the conversation between, and I'm not talking about just VC funded companies, just investors in general, right? Even if they're public market investors, they don't have an infinite amount of patience with their money, right? If you've raised money to run your startup, you should have an outcome before you run out of money. Then you have PMF, and then you can make these choices.
Of course. Vinod sir, I have to ask you, I mean, you've gone through so many industries over the last so many years, right? When you look at any kind of business model, how do you define whether it's sustainable or not? Like, do you define it in terms of growth? Because Amazon is sustaining, right? Or do you define it in terms of profits? How do you define a sustainable business model?
Let me start with healthcare.
Yes, please.
See, one of the segment where we are looking at is these, LASIK operations actually.
Okay.
For the eye. So the equipment cost in crores actually.
Oh wow, okay.
There are equipment worth up to 5 crores. So if we wanted to convert to currently those surgeries cost in the market anything per surgery 1,50,000.
Yeah.
So we wanted to price at a very lower end actually.
Okay.
See now how do we evaluate? Okay, see how many cities we can operate. How many how many such equipments we can, whether we can buy it or lease it.
Yeah.
So instead of owning it, we can lease it also.
Yeah.
So we have to look at those options, and also like what will be now even after investing, how do you know whether you will get that many customers?
Yeah.
What is the current in our business majority is sourced through the marketing, Facebook and Google, where we pay a huge premium for CAC acquisition actually. So it should make a business sense. So that is where this is one of the key decision where we have to take whether it is sustainable for us actually. See, we cannot just like that buy 5 crore investment, you do it and then leave it to the marketing team or anybody else, a B2B team, and things are not coming, then we'll be in a soup actually. So that is where we need real understanding about the cost of the product, cost of other each cost lines, be it CAC or operational cost, fixed cost versus other city operation cost. See, all these things we have to be on 100% vigil. See, even if even I told you like daycare surgery there are so many categories like general surgery, optal, orthopedic. So here also like we have to look at what is the cap for each category.
Yeah.
and also where it is possible, which city we are performing.
Yeah.
So all these things are, really we have to really look at.
Yeah.
And also we have to look at preferably on-time basis, or at least very dashboard and all should be available. Otherwise, we cannot run a campaign and also we have to really schedule in our case we have to really schedule the surgeries.
Yes, of course.
See, one of the issue for us is surgeon won't be available. See, they also have preferred slot. Customers also have a preferred slot. They want on weekend, but these guys don't want it to do it on a weekend. So we have to really look at the demand supply of surgeons qualified, because we cannot compromise on the medical outcome.
Of course.
Though we are reducing the cost, we cannot compromise on the and also it is life. If anything happens, there will be another repercussions actually.
Yeah.
So there is no straight answer. See, for industry to industry, the parameters or the yardsticks will be different.
Yeah.
But that is where if you look at a 360-degree view and include all business leaders within the organization or the stakeholders, that is where we can take implement a sustainable model. Otherwise, it's if you're just operating from your head, okay, my gut feeling is like this, and you go with that investment, it's like a hit or miss case actually.
Of course.
So that's what I want to say.
Ankit, I wanted to understand from you, and I say this because I probably don't know much about the industry that you're in, but when it comes to you guys are kind of directly competing with the likes of Uber, Ola. I mean, not exactly, but kind of there, right? So how do you guys view your growth versus profitability questions, in terms of the kind of competition you are dealing with as well?
Yep. So Yulu operates in different verticals, I would say, and competition also, then definition of competition also then
keeps changing.
And then for each business line, then you think of the strategy. So let me tackle the first one that you said, which is mobility, last mile mobility for folks like us. Now, anything that transports people from point A to point B, including personal vehicles, in some sense are a competition. But that is where you have to pick and choose, where is it that you're solving a real problem? What's the unaddressed market that you're going behind? And we don't want to be a me too, trying to solve something that an Uber or an auto can do. We're not trying to substitute that space. What we believe is that in India, there are a lot of people who would prefer an efficient mode of transportation, even if, let's say, they have their own vehicle. Right. So, and that is where all the choices, from product choices to the kind of value proposition that you build out to the kind of people you market it to, changes. So for us, our solution is really about being affordable, accessible, and available for people, which means even a college student should be able to use it. Even a working professional should be use it. So from an accessibility and availability point of view, we should be able to cater to both. But on affordability, I have a choice to make. Am I targeting a corporate guy who can probably pay 3x the amount that a college kid can? That is where then you decide, okay, and for us that is the decision that we want to price our services in an affordable manner. So in the pecking order, I really want to go to the guy for whom other public transport or other transportation modes don't make so much sense. That's one set. Then there are people who care about the environmental impact, the quality of life in the city, right? So we want to go to those people who care about green mobility solutions. So and then depending on the scale that you want to achieve. See, right now Yulu as a company is 20% focused on that part, which is why the addressable market that I need to go to is really within certain bounds. So we don't really need to try hard to woo everybody. We know who we want to go behind, and we just double down on those kind of people. But the other side, which is 80%, and which is where the last mile delivery space comes in, is where really the question of growth versus profitability is. Because the dynamics of that segment are very different. The abuse of the vehicle in a commercial sort of use case is much higher. The average kilometers that vehicle runs every day is much higher.
Yeah.
So the first question is your vehicle, what is your vehicle's design life? Can it handle 600 days of such abuse on the road?
And it's just 2 years of the operation. Oh
yes.
Wow, okay.
So can it sustain for 2 years? And in those 2 years, if you have to make money every single day that this vehicle is out, what is the money you need to take back? Especially, it should be able to fund your cost of operations.
Yeah.
Right? So, I'm also going back to the original question, and a lot of interesting perspectives have already been put there.
Yes.
But all costs are not the same, right? I mean, there are some costs that will go down with scale.
Yeah.
But there are some costs that will not.
Yeah.
And hence, when you are looking at the profitability part of the equation,
Yeah.
you should be able to see, is the cost, is this cost going to change with scale?
Yeah.
And if the answer is yes, then it's okay if that cost is right now out of bounds. But if that cost is not going to change with scale and it's still out of bounds, then you're just procrastinating or deferring a problem to the future. And honestly, you can manage it much better when it's small. Because after that, it's a make or break.
Yeah.
So I think for us, the choice has always been about between growth and profitability. We've always looked at unit economics at a per ride level, per vehicle, per day level.
Yeah.
If you're not making money there, then we refine our model till the point that we know that we are unit economics positive. And then, yes, growth, because there is also network effect. Now, the other part is, if I am a shared mobility service provider, I have energy needs. I need charging infrastructure. I need swapping infrastructure. I need partners for that. Partners want to know what is the volume we can commit so that they can set up nodes at every 2 kilometers to serve me, right?
Yeah.
So unless I'm able to project a certain scale, others will not put money. Ecosystem will not put money. And which is where I think the balancing act is, that which parts are okay to be pursued from a growth perspective and which are the ones where you look at cost very tightly. So,
interesting.
those are the dynamics that we kind of straddle with every day.
Okay. Maxson, I have a question for you, because what he just mentioned, Ankit just mentioned, logistics is a very capital intensive industry, right? So how do you guys, when you guys looking at maintaining the financial health and stuff, how do you guys manage your fleet and the network and everything? What are the decision-making processes like?
Right. I'll start off with our CFO is more important than our CPO.
Fair enough.
So what it tells you is...
By the way, I think you just answered the first question.
But I like the win versus die. I mean, that was a very interesting and I really believe that's the right thing. So what we logistics or even any asset, we are not only asset intensive, we are also operations intensive. So these are two major, and most of us here are in that space. For us, we had to break it down to the line items, so we don't have cuts only by the spend types. We have broken up each city into a P&L. So we track, like you do it at a ride level, we've had to do it at a monthly, this reporting happens by city level profitability. So we have a city head whose entire job is to make it profitable. So like you rightly said, there are some costs which can be apportioned, some costs cannot be. So we have each line item in our cost structure has been identified, whether it belongs to the city head, whether it belongs to corporate, and we've kind of worked that out. And hence, we had to invest a lot into the reporting system, the MIS for us.
So there's a person in charge for all sorts of profitability.
So every cost has a person assigned to it, right? The only corporate cost which I sign off on is on marketing. That's the so for us, it was difficult, and let me tell you the journey for us. It was difficult because when you initially start off, we can't say we have to be profitable from day one. That time we had to get into the lease versus We did that. We got into but that time no one really believed in the entire electric mobility. So we had to put our money, build it up to a certain scale. But then we decided to take city by city, and I want to tell this upfront is unlike most of our competition, who went into a spread mode. I mean, we were stuck at 4 cities for 2 long years. We just said only 4 cities. We will not go to the 5th city till the time we don't get the process profitability right in the 4 cities. Unfortunately, now we are the only one standing, if I were to put it that way.
Yeah.
So it's a question of, I believe that it's any business. You can do a cut of P&L at an SK level or a city level or a ride level. But the fact that if you're having that cut and someone is monitoring it, so for us it was a city level profitability.
Understood.
We are now looking at city-wise, client-wise profitability as well. But it was a work in progress for us. We couldn't do it upfront, but it was a learning on our way. For you, it could be I'm just trying to step into someone else's shoes and saying, hey, listen, you decide the cuts, and if there is at least one of them showing profitability, it's that light at the end of the tunnel. That if all of them are dark, something is really wrong out there.
Monitoring has to be on a live basis possible.
Yeah.
Because if you get a postmortem data after 3 months, 1 quarter is over.
It's over. You can't
then you already 1 quarter is over.
Yeah.
So if you don't have the metrics dynamics reporting well in time, you should know where are the pointers.
Yeah.
Otherwise, again, there is a pitfall.
Yeah.
Actually, you can't improve what you can't measure.
Oh yes, absolutely.
That is true. That is very, very true. Amitabh, I wanted to ask you this. So EV market penetration is, we are still very low on that category yet, right? So how do you guys tackle the challenge of market penetration without sacrificing margins in the early stages of establishing yourself as a player?
You don't. This is true for every startup.
Okay.
Look, and especially if you are creating an industry. Let's be very clear about this. One is there are already a lot of players and you are another player. Maybe you've chosen another vertical to get into it. I think the basics, within this group, we all understand there's some fundamentals of running businesses.
Yeah.
Business itself means you have to think like a Marwadi Baniya. Boss. If I'm not getting to profitability, something is wrong. I have to know this for sure right in the beginning. Number one. Number two, I think we do keep forgetting that we are looking at profitability of one individual or one company.
Yeah.
Unless there is profitability of the entire ecosystem, this is not going to work. Right? I can say that I'm being profitable in selling this vehicle, but if my financier is not making money, if the support guys are not making, the service guys not making money,
the entire value chain.
Exactly, the dealers are not making money, I won't be able to sell my vehicle. So I can keep demanding a certain price, but that's not really going to help. For your question, there's no doubt about it that when you're creating a market, you're creating a need in this marketplace. And just so you understand, there is a personal vehicle space and then there's a commercial vehicle space. Of course. Electric vehicles, when you're trying to sell a new concept in a market, India and for that matter every country in the world, you start looking at the total cost of ownership, right? How much are you spending to buy this new technology versus how much will you be getting out of this larger investment that you're making? I think in the personal vehicle space, the rest of the world operates at the personal vehicle space. We're looking at passenger cars and all that. There are pretty much zero TCO benefits. Even if you're riding a 2-wheeler, I can say this, I'm not talking about Yulu. But even if you look at regular 2-wheelers or for that matter passenger cars, there are no TCO benefits. You drive 22 to 30 kilometers on a daily basis. It'll take you 10 years, 11 years to recover. On the commercial vehicle side, however, you start making money on day one. And hence, even regular platforms like a Yulu is going to be used for commercial vehicle applications. So there are two very different things. The question is, when you're getting into an industry, which one should you focus on first? You have to realize that this is going to translate first. Let me focus on that, and then at a later point, I might decide to focus on another vertical or get to another use case or address another use case as it becomes more relevant. And that's how you can segregate yourself and say, okay, I'm going to focus on this. Case in point, Altigreen could have made a 2-wheeler, a 3-wheeler, a 4-wheeler, or a tractor. We could have made any of these 4. Honestly, I won't get into the history, but we could have made these 4. Why 3-wheeler? It's an unsexy vehicle. No one wants to invest in it. No one wants to fund it. 400 million people access a three-wheeler every day in this country. If I want to make a change, I have to get into that segment first. That's the only way to make change happen right from the ground. There are TCO benefits. It's very difficult. No one wants to finance these vehicles.
Yeah.
TCO drivers. कौन देगा यार इनको? वो प्रेशर कुकर खरीदने में उसका EMI वो गड़बड़ सिबिल स्कोर गिर जाता है.
Yeah.
So I'm just saying that there are lots of things that you focus on, and
Yeah.
then you decide, okay, this is that segment that I will focus on.
Yeah.
But the idea is on day one you should know how you're getting to profitability, and I think that's what is
Understood.
very
Yeah.
What's interesting is I just realized when you were saying this, one was depending on the competitive landscape. You have to win or die. The other one is if you're a category creator. Right? Like for example, I think some of the work that's happening in the EV space today.
Yeah.
About category creators.
Yeah.
You can't be profitable on day zero
Yeah.
if you're creating a category.
Yeah.
I don't think it is possible. Like, if you are, then it's amazing.
No,
But
that's
you
that
just
visibility
can't.
to
You have to
profitability.
invest
Yeah.
upfront.
Yeah.
And then you have to hope and pray
Yeah.
that
Yeah.
you get there. But it's interesting.
Yeah. I also want to understand from you, Abhishek. Yours is also the company who, I mean, one of the few in the at the table here who's also investing a lot in cold chain supply and the entire supply chain side, right? How are you guys focusing on the entire supply chain and still making sure all your costs are well within your budget and you're still hitting your growth and profitability metrics that you have set out for yourself?
Yeah. So I think 2-3 things. One, there is an ecosystem effect, which I think Amitabh you also mentioned. You can't do this without every part of that supply chain as an ecosystem working for themselves.
Yeah.
Seafood is an extremely fragmented supply chain.
Yeah.
Simply because internally the joke is that we are dealing with a time bomb. Right? So by the time you get it out of the
It's
water
perishable products.
onto
Yes.
somebody's plate, every guy is in a hurry to hand it over to the next guy.
Yeah.
That's essentially how this supply chain works, not only in India, globally.
Yeah.
Now, what we have realized is that usually the number of touch points between source to customer is around 7, usually.
Okay.
There are only 3 that matter,
Okay.
right? And the 3 that matter are the 3 points at which it is stored for the longest time. It's not about the number of touch points, it's about where it spends the longest time, the product.
The length of the time.
The length of the time.
Yeah.
And so what we have done from day zero and now we continue to do is in those 3 critical touch points, we invest heavily on assets that are driven by our tech.
Understood. Okay.
In all of the other touch points, it is not driven by our tech, it is monitored by our people. So there's a difference there. There's a people solve and there is a tech solve.
Yeah.
My tech is needed where if I don't have 100% real-time information of those 3 steps in the supply chain, I will lose the entire value of the product. It's good fish versus spoiled fish.
Yes.
Right? But the other few steps are not that critical but important. So I have people who kind of monitor,
Understood.
keep logs, do all of that.
Yeah.
The other reason why I think India and even actually one of the other interesting things about I think our industry is that we weren't born yesterday.
Yeah.
People have been trading seafood. In fact, I think other than a few other industries, the oldest trade known to man.
Yeah.
Right?
It is. Yeah.
So there are many things that this industry has solved for themselves
Already. Yeah.
They've been doing this for hundreds of years.
Yeah.
I think where we are hoping to add value, and I think to some extent have added value, is the fact that a lot of these things have been solved for in silos. Like so many things that have happened in the US supply chain of seafood has not seen the light of day anywhere else outside of US.
Has not been replicated in India.
People don't even know.
Oh.
Forget replicated. Right? Like to give you a broad example, right? I think at some level there is so much of cross-pollination of ideas, especially in this internet age.
Yeah.
Because you see something that's working in a different
That's the
country
whole point.
and then you bring it
don't
here.
have to reinvent the wheel.
Seafood is oblivious to anything that's happening outside of that little bit of. And it happened to us as well because we started here, we were an Indian player. The first time we went and visited, some markets in the US, and I think I've been to 250 markets in India, fish markets, right? The first market I visited in the US, they're solved for every problem that we looked at in 250 markets in India. they solved for it at least half a century back. They solved for it. It's there. But nobody is applying that here or anywhere else. Like forget US applying in India. Europe doesn't have the same thing that the US has. And vice versa. There is some stuff that Europe has, like temperature controlled rooms. Came into the US much after it came into Europe. Right? And some of these things are very weird in today's day and age. Right? It was okay if you had to send telegrams and So I think that has also given us a great opportunity to kind of cross-pollinate ideas, to kind of cross-leverage some of these inefficiencies. So yeah, broadly that's how this is played out. And tech is the great level up for sure. It's amazing how, and again because I came from the fashion industry, right? And that I think need a lot more time to explain as to how fish is actually like fashion. Right? For the lack of a more unsexy category getting related to a sexy category. But it is literally weird how similar they are. Because fundamentally it's a perishable product versus a non-perishable product. But customer sentiment is very, very similar. People are very subjective when it comes to consuming fish, because fish is not chicken, or fish is actually a very nuanced taste. You're a Bengali, you would know, right? Even in India, there are 2 states, Kerala and Bengal, that consume 70% of the seafood in the country. Right? Just 2. So all of these nuances actually helped us learn, helped us this one. But fundamentals is figure out what are the critical points in the supply chain. Every supply chain is fragmented. There are multiple points. If it's a perishable product, you can't solve all problems all the time.
Of course.
Pick your battles, solve for those battles. Everything else will hopefully.
Understood. Vanda, my next question is for you. So e-commerce as a channel is infamous for being expensive when it comes to cost of acquisition of customers and so on, right? And we started the conversation with saying that you guys are also focusing on GT now, right? So for you guys, now I understand that you are expanding into other channels as well. When you guys were only in the e-commerce space, let's say, how were you guys focusing on the profitability part when the costs were so high? And I'm assuming beauty is a category which requires a lot of repeat consumption. That's the stickability of beauty, right? And that's what makes sure that the business is steady. So how were you guys focusing on profitability and growth when the cost of acquisition of each customer was so high?
So I think very in growth marketing, right? If your organic, your contribution is high, then your CAC also becomes lower. So what does that mean is at any given point of time you have to create intent and make consumers really want your product. So they proactively come to a platform, to Google to search for your product. So when that happens, then you're actually you're spending as a proportion lesser on paying for them to actually come to it.
Understood.
So how do you create a brand? And before that, how do you actually find a product which consumers actually want? So I think what we have done really well, and that's the playbook also, is identifying trends. If you see the consumer care space, say 10 years back, right? If you see in FMCG, there is this term called MOUB, which is most often used brand. And every big FMCG, Britannia, Unilever, P&G sees that as a monthly trend, and it is given to us by Nielsen, by TNS. So what we see in categories, right, there are 1 or 2 brands which are the go-to. So if you see our bathroom shelves, there used to be 1 shampoo, no conditioner, 1 face wash if at all. Else everyone, the entire family used to use 1 product. And that's how legacy brands grew, right? What we realized is an opportunity for people to actually buy more because their needs are different. You may have dandruff, you may actually have different kinds. So what we did is we launched products with innovative ingredients which no one had seen before, and therefore built the intent. So what happened is because the offerings were so unique, no one really had seen it. It was great brand building. So people proactively went to Amazon to actually buy it. And what we did really smartly is use a channel called influencers. So legacy companies used to always use TV, they used to use mainline media like print, etc. What we tried to do is no one had actually really capitalize on influencers, we grew the trend of influencers. So if you saw someone on Instagram or YouTube Shorts saying that, oh, this rosemary shampoo really works well for me, so proactively you say, okay, there's something here, let me buy. So what happened is we actually pushed a huge amount of people to proactively come organically to search for our brands. And I think that's what happened on Amazon, because they started Instagrammers, influencers. They used to give a code or a link, and people actually landed up there. So you didn't pay the platform. So what Amazon also realized is this huge, band of brands out there who are actually creating these products. They proactively actually gave us space because it was also driving traffic to the platform. So I think we rode that way very smartly, built brands, and therefore then inherently the demand came also on the GT stores. So that's how the entire chain was built. But I think in consumer care brands which are monthly purchase, right? For me, loyalty is very, very important because we buy shampoo, conditioners. So it's very important to remind consumers to buy very frequently. Secondly, is product also has to be key. If it doesn't work, they're not going to buy you. And thirdly is use these channels to be able to reach. So I think if you do that without paying organically, people come, so your cost of acquisition actually goes down.
Personally, because I cover consumer as well, I feel like how the Korean skincare beauty, they sell a regime to you. They don't sell a product, they sell a regime. So you're not buying one product, you're buying 8 products.
Correct.
And that kind of stickability is,
it's phenomenal. And consumers are also changing, and I think new age brands like this, right, they understand that there is that bit of change which you can actually affect. For example, for the longest time, I was convincing my husband to buy a face wash instead of using soap on his face, and he said, no, men don't use face wash. And today, he has 3 kinds of face wash.
And hyaluronic acid was
And hyaluronic acid. So consumers are changing. It was MOUB 1.
So,
I mean to say, this is how you
makes
actually
sense.
build
Makes
brands.
sense. Hemant, my next question is for you. You guys mostly deal with B2B, and customer retention, especially B2B customer retention, must be a whole, beast of its own. Let's put it that way. So, how are you guys focusing on that, along with your growth versus profitability targets that you have set for yourself as Ninjacart?
So, see, this is a very interesting space, right? Like, so I, similar to Vanda, I have a background in FMCG, and then I did a little bit of B2B. And when I came to Ninjacart, I realized it's not necessarily B2B. Right? Because see, my time is what 500 million. Majority of them are farmers, and the others are traders and retailers. And frankly, I'm not selling to an organization. I'm talking to a trader or retailer. It's a person with a need, and I'm trying to address that need. So it turns out to be it turns out that a lot of the B2C principles apply here in the B2B space as well. So if you were to look at how we even look at targeting these consumers, right? At the base level, the biggest thing that we realized was these guys do not interact with brands as much as the rest of the world. So going in with traditional principles of branding would not really work as well. And add the added layer of some of them being educated, some of them not being educated, some of them being risk averse. All these factors come into consideration, right? So when you try to acquire them, I think it's how much you can really convince them to come and use you once, right? And the way you go about doing it is through a variety of ways. See, initially we've realized that these are guys who are going to only stick on to you if they have one very favorable experience. Second, if they think there is real value to it. So the starting point is, what value are you providing?
You have to establish the value at the very
what value are you providing? Are you really providing value? And how do you bring that across to them? Right? So today when Ninjacart looks at it, we think there are 3 things that most of these guys work in, right? One is there's risk, there is capital, and there is commerce. That's primarily what a person's trying to do. If you look at a farmer, he needs money. He's worried that like if there is some weather disruption, that's going to affect his produce. And finally, he needs to sell it to someone at a good price. And you are trying to build solutions that are going to really help them in this space. Now, we also need to understand that while we are non-traditionalists, there are also traditional companies. Like if I say I'm going to give you capital, there is a bank sitting there somewhere saying I'm going to provide capital as well. So what is the differentiator? What is it that you bring to the table that's actually different from what they bring, and why they should even use you, to even consider you as such, right? And that's the starting point. The next bit is obviously the ways you want to acquire. See, we can be a digital first company. We might have 5 apps for all of these guys. But the realization that almost everyone knows on the table is you don't need to necessarily acquire them through a digital channel even if you want them to become digital savvy.
Okay.
So today we use a lot of offline channels. A lot of today, if you see, outdoor is a big thing for me across these ecosystems to just drive awareness. BTL activations are a big thing, and feet on street to convert them is the big thing, right? But once you, but you can also layer it with certain interesting trends, right? With a lot of us have referred to trends that happen in the ecosystem that you have to be aware of. So there, in the agri space, there's something called as micro-influencers. Micro-influencers are guys who've got like 50K distribution, 100K distribution. But guys that every farmer, every trader looks at, whose content they consume every day. So for example, there is a micro-influencer who publishes prices of mandi across India. And he's got a religious bunch of guys coming to him really. So it's about activating them, using them
almost
as...
like the APMCs, but digital.
Correct. Exactly like the APMCs, but digital.
But digital,
Right, and so you use them. They become your voice. Right, and we've realized at the end of it all, the only way this is going to grow and scale with profitability is when you reduce the cost over a period of time.
Of course,
Right, and there are 2-3 factors too. One is the principles of FMCG still applies here in the sense that you've got to build a brand. It's not about a transaction. It's not about connecting with him only when there is a need. You've got to show value.
Okay.
The second bit is you need to see what are the other ways to retain him. Right, and when I say other ways to retain him, there's a little bit of deep diving. Right, you get into segmentation, understand what is his core need, and start building products, upskill, cross-skill. And you can do that through a variety of things, right? Which is on product, it could be a referral program, it could be customer testimonials talking about value that the product has provided, or eventually, finally, even a loyalty program that works, right? But at the end of it all, if there's one objective that you want to drive across, it's that the customer should not think that you're just a one-off brand that's going to come interact with you for some time and then just follow
you
need to be a person who's building a consistent relationship across. And I think that's the only way to reduce cost,
and
increase.
I guess that's across all industries, irrespective of the nature.
So I don't think the principles change, right?
Yeah,
like if you see all of us talking, we're all talking the same thing. But the application probably will change a little bit here.
Understood. Ankit, my next question is for you. So Yulu is a very interesting product, and demand generation itself must be quite interesting for you guys, especially because of the kind of split in terms of your consumer segmentation that you mentioned, what the 20% versus the 80%. I don't think the demand generation will work for one for the other, right? How does it work, and how are you guys focusing on that, keeping in mind, again, your profitability goals?
Yeah, I think both segments are very different, but the good news for us is the larger segment that we focus on has, they're like, I can think of honeycomb and honeybees. So all the delivery guys, ultimately they cluster around few dark stores. There are few hotspots like restaurants which deliver tons of orders every day. Then there are recruitment centers where these delivery companies try and source their manpower, or they have these touch points which are recruitment centers. So for us, really, we know that at least for that first wave of growth, what we focused on was we knew where these guys are, and we went there where they were. And honestly, when you're trying to sell a new proposition, there's nothing better than somebody explaining it to you in person, giving you an experience of how it works. So the journey from 0 to, let's say, 10,000 users that we wanted to get was very, very high touch, very, very localized to around these dark stores.
Very on the ground.
Yes, very on the ground. And honestly, our job was a little easier with the first 10,000. After that, we're currently sitting at around 30,000 plus daily active users of this category. So the next 20,000 was a lot about making our acquisition efforts more structured. So we
10 to 30,000, right?
10 to 30. So which meant that we know that a lot of our customers work for some enterprise in the end. So how do you build those relationships to ensure that you are working more in tandem with them? We understood some need gaps that those organizations have on the supply side, which through our product market fit, we were able to really plug in a very solid gap. Just to say it in one line, 85% of people in India don't have a driving license.
Yeah.
To deliver, you need a vehicle. To drive a vehicle, you need a license, right? So if Zomato wants to increase its funnel of delivery riders by 3x, we could do that because our vehicle doesn't need a driving license to be ridden, as per law. So and I think where we operate, we think it's a safe space. But yeah, policies. Not commenting on how policies might change.
This is very
And so we were filling a gap, but we wanted enterprises to know about
it. Of course, yeah.
And when they came to know about it, obviously there was so much more. I would say they were very receptive to what we had to offer.
Yeah.
So that was the next stage of the journey.
Yeah.
And then now where we are sitting now, if we want to go from where we are to our next milestone, we know that we will now have to start tapping into tapping the whole delivery job market, which means why this proposition makes sense for somebody who's earning anywhere between 15 to 20,000 today. Why should they look at a delivery job?
Yeah.
And if they look at a delivery job, why Yulu is the best way to get started, no matter what enterprise you choose. So for us, now is when there's a lot more effort that needs to happen into brand building in front of that audience, to building brand salience, putting our value proposition out.
Yeah.
Because now we are talking to people who are, we don't know those people. We don't know those faces.
Understood.
We are targeting them. We are now going mass. So our strategy now will require a lot, it'll be very different in terms of how we go to market now. So in summary, from high touch to more partnership driven sort of model to something that will be more marketing led is.
Understood. That brings me to the last question, and that's for you, Sir Vinod, sir. One of the things that I could gather, and please correct me if I'm wrong, is that you guys are trying to make expensive medical procedures accessible to more people. How do you do that, keeping in mind long-term profitability?
See, another one is the knee replacement, robotic procedures.
Yeah.
So if you look at the market cost is 350,000 for a normal procedure. When you use a robotic procedure, it will be less.
Of course. Yeah.
Okay. So.
But are you educating your consumer as well? Is somebody comfortable with the robotic procedure?
Yeah. See, outcome is there is no, primarily there is a financial benefit.
Yeah.
See, so far, wherever we are doing the procedures, we didn't find any fault. Some of the cases we may have to redo it or do some post support actually.
Yeah.
Okay. So what I'm saying is it depends on the kind of procedures. Okay?
Yeah.
So it could be it could be doing it on a high-end machine or so that is one aspect. Second one is like robotic and all. That is where the major hospitals are now moving.
Okay.
We are tapping that also, whether we can do it on a ambulatory service unit centers, a small surgery setup actually. So and also we have to really look at all the cost elements actually.
Yeah,
so if you really look at the primary one is the CAC. If we are sourcing on the online media. The second one is the surgeon cost actually. Okay, so that is the second component of it actually. Third one is the hospital cost, which facility we are using, what is the line for them.
Yeah.
The fourth one is the consumables, which are all the consumables required for that procedure.
Yeah.
And
do you include your medicines and
that is
Okay.
So in that one it will come, and there also there are different procedures some of the catheters can reuse it, sterilize it and use it. So we have to look at all these things. So some of the surgeons, every time they want a new catheter to use. They don't want the old one to be used. Some of the patients are also very clear, which catheter are you using a new one.
Mm-hmm.
There are nowadays insurance companies ask the code number on the bill, or if something is done, whether it's actually put. If a stent is implanted, you want to keep the barcode also copied and pasted on the bill. Actually.
Wow. Okay.
So that is where things are going. Otherwise, like you show something and bill something. So those how do we manage the cost structure is like we really looking at all the aspect of it, and also then definitely our fixed cost that also we have to keep in, and definitely there is a margin. Okay. So basically this should be really it's like we should know what is the internally cost for me, and what is there in the market. Like some of the new launched market, like if you are opening a new city or the competition is already there, what is their pricing, and also what is the insurance pricing. So insurance companies also take in advance the pricing. Otherwise, like if you charge over, then that definitely that get not passed those bills actually, or they will do the deductions. Say as per the package approved is this, so they disallow that. So you knowing the different cost aspect of it actually, and also like this is very important actually, and also like you also like what is the preparedness for a new city. Like some of the in the marketing campaigns we may be good at certain categories, but if you start a new category, the cost may be higher actually, for a new city or. So we have to really, that's what I said, this segment where you should definitely know the cost, definitely start with the estimate, the unit economics, like definitely we have a plan. It could be the overall model where we list out everything and arrived at a whatever margin, 20% or whatever the margin we are looking at. Then we have to look at city level also, like whether it will be possible. City level, even at a category level, whether it is wise to continue.
Like Maxson also mentioned, the city level data is like
whether it is wise to continue or we can test it out. We'll start with few this one. If it doesn't work, then we have to take a call on that category.
Of course. Right?
So as a person, like we should really look at all the aspect of the cost.
It's not one thing inside those. Everything is
and also like as many of you the speakers told here actually, see each industry have different yardsticks to look at it actually, and that is how we can bring the balance between the profitability. And also like another point on growth is like, see we all to complete our education it took some time. There is a gestation period actually, right? So growth is definitely, it takes a new business certain time. Then only the profitability comes actually.
Of course.
Right. So there is a gestation period, but what is a gestation period and how long, how much it cost? That is where each business or
balances.
There they have to be, make a common sense or that is where we should be mindful actually.
Understood.
And we should be alert and we should keep on monitoring. That is where there is no, there is no right way to say whether growth has to be done first or then profitability or profit. Some of the Ninjacart, they already said they look at the profit first, then go into optimize the operational cost and all, and or maintain that whatever they are expecting. So like that. See, every industry, the key stakeholder has to take a view and be, responsible for that.
Okay, so that brings us to the end of the discussion, and it feels like what we started with, understanding the balance between growth and profitability, is it's not a one-size-fits-all sort of a solution. But thank you so much, everyone here. I had a really good time having this discussion. I hope all of you had a good time as well and have a few takeaways, to go back home with. But thank you so much, and we will just do the closing now. I wasn't sure. Which is well. Thank you so much, everyone. But have a lovely weekend ahead, guys. And
Thank you.
All right, thank you.